Welcome everybody to Volatility Trading Strategies and this final part 5 of the risk-adjusted return series. Now, I'll almost certainly do more on this topic in the future because there's a lot of these metrics that are more useful to investors than just looking at the rate of return by itself. The ones that I chose for this series are, in my opinion, a great first step because not only are they very useful to do a comprehensive analysis of investment performance, but they're also easy enough to understand, which is important as well. So now we've got dedicated videos for the Sharpe ratio, the Ulcer performance index, maximum drawdown, and correlation to the S&P 500. So in this video, we're going to review them all and put them together. And I'll also do a video showing you how I personally use them to build my own diversified portfolio because, of course, it's important, but I also really enjoy talking about this subject as well. It may not look like it. Most of you know I'm not a very excitable person. Even back when I was playing professional golf, I was never the type to be running around the green, high-fiving, and fist-pumping like Tiger Woods after making birdies. Not exactly my style. For me, it was just a tip of the cap and I walked to the next tee. So no fist pumps for this video, unfortunately, but I'm really excited and this one is all about you and how you can use these risk-adjusted metrics to help you decide which funds or which trading strategies are going to help you achieve your goals. So let's get into it. So of course, I don't know what kind of investor you are or how well you do. For all I know, you're a trading genius. But just for this video, allow me to call you the average investor. Now, the average investor has two disadvantages right from the start. And the first is, successful investing is hard. In the short run, it's not, but there's no such thing as free money. And when stretched out in the long run, when you include both bull markets and bear markets, good times and bad, it's actually really hard to get a good rate of return. I've done my best over the years to try to show people the actual rate of return that the average fund manager is getting their clients, just so that everybody has the proper context. And spoiler alert, when you back out inflation and management fees, it's actually not very much. Hedge fund indexes are hovering around 3% a year. Maybe the average investment advisor is slightly higher at 4 or 5%. But again, when you back out fees and inflation, it's really pretty low. Like I said, there's no such thing as free money, and investing is hard. The second problem the average investor has is they have a job. They may have a family. They have hobbies. They just don't have the time to fully immerse themselves in the investing world. So they become very susceptible to what I call popcorn marketing. Invest with us because we made X% rate of return, or look how great we did in July. Don't miss this opportunity. It all becomes very surfacey, and marketing experts in the financial industry, they really know how to condense things down into catchy headlines for people. So what I'm trying to do in this video series is equip people with some additional tools to go a little deeper, to get past that headline number and to actually start making meaningful comparisons between investment results. Extending the analysis to include some other metrics may help investors build a diversified portfolio that will stand the test of time and that will hold up during the most important investing periods, which is, of course, when markets aren't cooperating. So let's go through an example. Here we're looking at a comparison between two investment products. The XIV, which is the Velocity Shares Daily Inverse VIX Short-Term Futures ETN, and then the S&P 500. Now, I'm not advocating a buy and hold approach on either of these products. I just like to use real-world examples to illustrate things, but the process we go through here will be the same regardless of which products or which funds you're comparing. So looking at the annual rate of return, also called the compound annual growth rate, this is no contest. Of course, the XIV is far superior, right? Who wants a 13.7% rate of return when you can get 38.9%? And given the rapid expansion of daily volume on volatility products these days, it seems there's more than a few people out there who have reached the same conclusion. But remember, everybody's a genius in a bull market, and the XIV launched on November 30th of 2010, so it's never even seen a recession. These are just bull market results. But there have been a few significant corrections along the way that if we know how to analyze those, we can get a much better idea of what to expect in the long run. To do this, we're going to use our risk-adjusted metrics from all of the previous videos, starting with the Sharpe ratio. Remember from my dedicated Sharpe ratio video, the higher the number, the better here. Because the Sharpe ratio takes into account both the annual rate of return and the standard deviation of those returns, a higher number may represent more consistency. Now, if it's close, then we'll look to other metrics, but anytime there's a significant Sharpe ratio difference like we see here, it's definitely worth noting. The S&P 500 may not have returned as much, but it's far more consistent. And on a risk-adjusted basis, a case could be made already that it's the better investment. But looking at just these two metrics, I would imagine that most people will probably say that they'd still go with the XIV. So let's continue. Just like with the Sharpe ratio, the higher the Ulcer Performance Index number, the better. But the reason it's a superior metric is because, unlike the Sharpe ratio, which treats positive and negative results equally, just lumping them all into the standard deviation portion of the equation, the Ulcer Performance Index only takes into account negative months. And this makes sense. Of course, nobody gets stressed out over the positive winning months. It's only the losing months that we're trying to avoid. The Ulcer Performance Index is my favorite metric, and if I had to choose just one number to get the best representation of what it's actually going to feel like in the real world of live trading, it would be this one. It takes into account the rate of return, as well as the magnitude and duration of losing periods. We're always going to want to see a high Ulcer Performance Index, but in this case, the Ulcer for the XIV is 3 times smaller than the S&P 500. What this shows is, sure, it's been a bull market, so the raw return has been good, but it's wildly inconsistent and may not be sustainable in the long run. The Ulcer Performance Index can oftentimes reveal potential weaknesses that the rate of return by itself hasn't yet revealed. And a low reading here may be hinting that its days are numbered. The often overlooked category of maximum drawdown. The reason it's often ignored is because we feel almost nothing looking at that number. It's not our money yet. Now, the rate of return isn't either if we haven't started, but when we look at rate of return, our brains can easily imagine what it'll feel like to make that money, what we can buy with it. For the maximum drawdown, it's just, oh, it had some trouble in the past, but it came back, right? So no big deal. Our brains mostly just gloss over it when it's numbers on a page. But if you ever find yourself in the middle of a 74% drawdown, everything you thought about investing will be challenged and you'll very likely emerge from the experience with some emotional baggage. Selecting investments that have demonstrated lower drawdowns is all about preserving our emotional capital. All investing has risk, of course, and no strategy is immune to losing periods. But the less stress we put ourselves through, the more likely it'll be that we make rational decisions going forward. Oftentimes, after suffering heavy losses, people will do an autopsy of what happened, and it's often revealed that there were also large drawdowns in the past. And if it's happened before and it's right there in the performance report, we should always assume that it can happen again. And maybe next time it'll be even worse, so we should definitely pay attention to this number. In my opinion, correlation to the S&P 500 is extremely important because let's face it, in good times, there's no shortage of trading strategies that can get a decent rate of return. The real trick is not giving most of it back when the markets go the other way. And with respect to the stock market, it can really go the other way. During recessions, it's pretty normal to see equity markets lose 50% of their value or more. Any ETF, asset class, or strategy that is highly correlated to the S&P 500 may also follow it right off the cliff. Good performing bull market strategies that are highly correlated to the S&P 500 are a dime a dozen, and especially when leverage is added or people take on more risk. The rate of return can really look impressive during stable periods. But eventually stocks go down, and those strategies follow suit. And if they're risky or leveraged, they follow suit even faster. Like I said, I'm certainly not suggesting people buy and hold the S&P 500. We can do a lot better than that. But it does illustrate the point that we can use our toolbox of risk-adjusted return metrics and go from thinking that one fund is far superior to another to eventually seeing it for what it is. In this case, when we first started, it was no contest. One of them was 3 times better than the other. And that might be the case for some of the other comparisons that you do as well. One of them might have a significantly higher rate of return than the other. And if it was over a 10 or 20-year period, you could take that seriously. But when it's only a few years of data, that's when we need to filter it through our other metrics. Everybody's going to look at the rate of return first. That's human nature. And on first glance, we may be tempted to just stop there. 39% is better than 13, or 10% is better than 5. But I invite you to go deeper and to use your checklist, the Sharpe ratio, which takes into account the standard deviation of those returns. Consistency is rewarded here with a higher number. The Ulcer Performance Index will specifically target the losing months and give us an excellent gauge of both the magnitude and duration of drawdowns. If they're too deep or they're too prolonged, the Ulcer will reveal this with a low reading, so you definitely want a higher number here. Maximum drawdown is all about our max pain level, and instead of glossing over it, try to actually imagine what it would feel like to have real money on the line. Could you stay the course if it happened again? Sometimes investors find out the hard way that the answer was no, and they end up pulling the plug near the bottom. So definitely avoid things that would breach your risk tolerance if it repeated itself. And correlation to the S&P 500. One of the most common complaints I hear when speaking to investors is their frustration and exhaustion with doing well during bull markets and then giving most of it back during bear markets. The average recession cycle in the United States is about 6 years, and for many people, they feel like they're running on a hamster wheel. Every time they feel like they're making progress, getting higher and higher, the markets lose their footing and they tumble right back down. This is why I focus so much on risk management. So hopefully this video demonstrated how we can use these risk-adjusted metrics to make better investment decisions. Now, like I said, I'll also do another video showing you how I personally use them to build my own diversified portfolio. So stay tuned for that one. And of course, as always, if you have any questions at all about this video or some of the other ones I did, feel free to reach out and contact me anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.